Hi, my name is Laura Bitcote. Thank you so much for tuning into my channel. Today I want to talk about how to pay off a home mortgage that is a 30-year home mortgage in just 5 to 7 years. I'm going to be going over the strategy, and a lot of people ask me, can I apply this towards a car loan or student loans? And yes, you can, but I'm going to insert a disclaimer that before you jump in and start using this strategy, I want to make sure that you understand it fully first, or consult with a financial advisor before you implement anything. So now, without further ado, let's jump over to the whiteboard and get started. Alright, I drew a little stick figure on the board, and this stick figure is going to represent an employee. And the average person in the United States makes $56,000 per year. For easier math, I'm going to round that up to $60,000 per year, which will come out to $5,000 per month in net household income. So this employee, all that they know of how to do is go to their employer and trade their time for money. Now I want you to take a minute and think about the process of what is the first thing that most people do as soon as they get paid. Alright, so the first thing that most people do is as soon as they get paid, they go to the bank and they deposit their money into either a checking or a savings account. The savings account simply represents an emergency fund in case of unforeseen events happening and you need to spend some extra money on something. Now, we're going to take a look at some average monthly expenses. And since I am covering how to pay off a home mortgage, the first expense that we're going to take a look at is a home loan. The average price of a home in the United States is $200,000. So that's the example that I'm going to use. Now we're going to have a 30-year fixed mortgage with payments that gonna come out to $1,200 at a 6% interest. The next most common expense is minimum payments on credit cards. So I'm going to take a look at a line of credit. And the limit on this line of credit, which we can say is just a Visa credit card, will be $15,000. Kind of everything looks very squished, so I'm going to move it over. $15,000. The present balance already is going to be $12,000. And the minimum payments, if the balance is $12,000, is going to come out to somewhere around $600 per month at a 21% APR. Okay, so looks good. So right from the start, we already have our two monthly expenses. This is per month. I just want to include that in here so that it's clear. Alright, so I'm gonna take that out of the checkings because that would be the process. So our first two expenses, home mortgage, HM, next is $600 for credit card, CC. Next most common expense are car payments because most people have a car. And I'm just going to say it's somewhere around $600 for a car. And everybody's got living expenses. So living expenses for a family can add up to somewhere $1,200. And that includes everything from groceries to utility bills to paying for the phone, for the internet services, and then whatever is left over will go into a savings account, which in our case is going to be $1,400. And this will include both long-term and short-term savings. Okay, so at the beginning of the month, we had $5,000 coming in, so that was our input. And by the end of the month, if we add up all the expenses and what went into the savings, we have minus $5,000. So that is our output. So at the end of the month, if we subtract our output from our input, we have a 0 cash flow. And this is a model that 95% of the population live by. It doesn't matter how much input, how much someone is making per month, because somebody might be making $100,000 per month. But if their output and their monthly expenses add up to $100,000 by the end of the month, they are still broke because their cash flow is 0. So now, how do you start to operate like the other 5% of the population do with their finances? So the first thing is understanding the difference between a loan and a line of credit. And we're going to take a look at specifically the interest rates, because if I was the bank and you had to borrow money from me, would you rather pay me at 6% interest or 21% interest? Of course, most people would say 6% because it's, first of all, it's a smaller number than 21, which actually in everyone's mind automatically means that you're going to be paying back less money in interest. So, but to understand the difference between these two, I'm going to use a little different example. If I was to ask you what temperature would it have to be in order for rain to freeze, you'd say either 32 degrees Fahrenheit or 0 degrees Celsius. But then what if all of a sudden it went up to 1 degree Celsius? Now which one is hotter? Of course, you would say that the 1 degree Celsius is hotter, but isn't 32 a bigger number than 1? Of course it is, but we're looking at a different unit of measure. So in our case, even though 32 is bigger and it looks like it is bigger, 1 is hotter because of it being a different unit of measure. It is the same exact idea when it comes to first understanding the difference between a loan and a line of credit. Even though this is a bigger number and it seems like you're going to be paying back more in interest, first we have to understand what affects the interest rates so that we see how both of these work. So now, on a line of credit, the interest, first of all, is simple. What that means is that the bank doesn't know how long it will take for a person to pay back this balance. And therefore, the interest is calculated daily and charged monthly. It is also revolving. What that means is that is two-dimensional. So I'll just draw it over here. two-dimensional. It means that as soon as that $600 minimum payment is paid, you can use your line of credit, you can use your Visa credit card to go to the movies, to buy some groceries, to do any shopping that you need to do, or to spend that money again. That means as soon as you pay, you can go back and use it again, and it's revolving. However, on a home loan, or just on a loan in general, as soon as you pay your monthly payment of $1,200, it is one-dimensional. So it means that when you pay that monthly payment, it just goes straight to the bank, and you cannot use that money again to do any shopping, to go to the movies. That's it. Another main differentiator is that it is amortized. What that means is that the bank knows that you have 30 years to pay back the loan, and therefore they calculate the interest for the whole 30 years and they bill it. So when you're making your monthly payments, the main portion, actually the biggest part of your payment, is going towards paying down interest, and just a very small part of it is paying down the principal. To better see how the banks calculate this and what that looks like, I'm going to draw an amortization schedule. Alright, so I got the amortization schedule right on the board, and as you see, we have the monthly payments on this side, and we have the timeline down here, which is basically how long you have, 30 years to pay off the loan. So since our monthly payments are $1,200, $950 of that $1,200 is going towards paying down the interest. $250 is going towards paying down the principal, which is $200,000. So this is what the chart looks like. As you're making your monthly payments every single month, interest goes down, and gradually you're paying more and more to pay off the principal. Right where they intersect is actually 17 years into the loan. That represents a point by when the interest begins to decrease enough where your monthly payments are paying off the principal more and more. So you see, it's only starting to your payments are really just starting to take effect 17 years into the loan, where it's actually starting to add up to pay off this principal sooner. But nowadays, a lot of people throughout their whole entire life are unable to pay off their mortgage for their home. And the main reason for that is what happens at the 4-year mark. Let's take a look. 4 years equals 48 months. Since our payments are $1,200 every single month, I'm going to multiply that by 48, and that gives us a total of $57,600, and that is going to represent total pay down. Now, $950 was going towards interest. That equals $46,500, I believe. Let me check that really fast. $45,600 went towards interest. So interest pay down. Total pay down on loan. Don't want to get that confusing. $250 equals $12,000, and that is principal pay down. Alright, so I really want you to take a look at this and see that in 4 years of making consistent payments of $1,200 on your home loan, for 4 years, which equals 48 months, you've paid a total of $57,600, okay? In our example, 950 of this would go towards the interest. So right off the bat, out of the $57,600, $45,600 went to the interest, and only 12,000 of these payments, not yours, I don't know what your numbers are, but of those payments went towards paying down the principal of the home loan. So that only knocked off $12,000. So now, what is the main reason that most people never end up paying off their home mortgage? Is that at the 4 years mark, the bank will call up a homeowner and say, are you interested in a great and lower rate? And all you have to do is just refinance your home mortgage. And most people will say, okay, sounds great, let's do it, without maybe even realizing what that really does. Because what that does is that it resets the clock, and it actually puts a person back at the beginning of this whole schedule. So you see, as time progresses, you gradually begin to pay less in interest. But now, even though you have a better maybe interest, it doesn't really matter, because as you're paying those payments, now you're still back at the beginning, where most of it is going towards paying down the interest. And people get stuck in this cycle, and if they keep refinancing every 4 years, that is the reason why they're not paying off their home. There's a great little app, it's called Carl's Mortgage Calculator. I will leave a link for it in the description of the video, and if you're interested in checking it out, it's free as of right now. But what it does, and why I like it and why I'm suggesting it, is if you actually want to plug in your own numbers for your home loan, and you can see basically what I explained over here, just with charts and a graph. But it basically will show you the numbers for your home mortgage. So you can actually see how the payments and the interest are tipping at the 17-year mark, and how everything adds up that I'm explaining right now. Alright, so I just wanted to show you the app, Carl's Mortgage Calculator. This is what it looks like. And if you download it, you can input all the values. Say, what is your property value, what is the principal that you have on your mortgage, what is the interest, for how many years, and then it's going to calculate the payment. Then you will have all the buttons right at the top here, and then if you just click on summary right over here, it's going to give you all the values. So I just took the numbers from our example. And as you see at the very bottom, the total interest paid is $231,676.38. So as you see, the 6% is not really 6%, because if you calculate everything, you technically bought yourself a house, and then you bought a house for the bank. Also, if you click in this app on table, you can see how all the payments are adding up until you pay off your home loan in 30 years. So I think it's a really cool app to check out for your home. Now, I just want to say that, does this look like 6%? And people don't realize this a lot of the time, because everybody, when they're taking out a home mortgage, is just focused on their monthly payment. But as soon as you begin to see what is the total payments versus interest paid, and you start to calculate that over time, it doesn't look like 6%. And the bank doesn't lie about it. It is all told and listed in the truth in lending statement in the paperwork when you're signing for your home loan. So now that we have this mortgage, what do you do to pay it off faster and save a lot of money on this interest? Alright, so this is where I get into the strategy. This is where I start to explain how to use what I'm gonna show you to save a lot of money on interest and to pay off that home mortgage faster. I just made some room on the board, but basically what this strategy that I'm going over requires is that you bypass the system of depositing your money into a checkings and savings completely and take everything that is earned for the entire month, your entire income, and apply it towards your line of credit. So we're going to move our monthly income towards our line of credit. Now it might sound crazy, but I'm going to explain to you what it does and how to continue to pay the bills using this method. Now, before I go on, I just want to say, why are people saving? Because a lot of people from a young age are told that it's important to save, and it is. But wealthy people know that you never want to let your money just sit. Wealthy people usually invest their money. And just letting it sit in an inactive account, it actually does more benefit to the bank rather than the person saving their money by letting it sit in the savings. The reason for that is that when you go to the bank and you deposit money into a savings account, the bank will offer you 1%. But when you're just letting it sit there and an emergency comes around, and let's say you have to get a brand new car, you go to the bank and you ask for a loan to be able to get a new car. And the bank says, great, so we're just gonna give you a car loan, but all you have to do is just pay us a 5.5% interest on it. So essentially what the bank does is they lend out your money that you're just letting it sit in the bank back to you and making money off that money. That's essentially how the banks make profit. And that's how it works. Now that we're bypassing the system and no longer letting the bank control our money, but rather we are in control of it, and putting it towards the line of credit, which is actually an active account, this is what it's going to do. Okay, so I just drew another graph on the board, and since we are taking our whole monthly paycheck and putting it towards our line of credit, right off the bat we had a $15,000 limit, so that's illustrated over here, with a balance of $12,000 currently on the card. And down here we have the timeline, because we're making payments every single month, so we have monthly increments. Now, if you do what the strategy says, you would take your entire monthly paycheck, which in our example is $5,000. So we take it from our checkings, it's deposited into our checkings, but we're taking all of it and applying it towards our line of credit, so that will knock our balance down by $5,000. But we still have our living expenses. So by using this strategy, let's see what happens to not just our living expenses, but all of our expenses. So since we moved our money over here, we no longer have to worry about our minimum credit card payment, since it automatically gets taken care of because we're putting money in that card, towards that card. So that automatically creates a $600 cash flow. Again, since we're no longer saving our money into a savings account, that creates $1,400 cash flow. So that equals a $2,000 cash flow. So now if we add up the expenses, it equals $3,000, because we still have to pay our home loan mortgage payment, we still have our car payment of $600, and we still have our living expenses of $1,200. So to pay those, we're going to use our card. And that same month it's gonna bump us up by $3,000. So this is our first month. Okay, next month we are doing the same exact strategy, and that bumps us down by $5,000, but we're gonna use our card, so it bumps us up again by $3,000. Second month. Third month, January. Same exact strategy. Again, we're paying for everything using our card. Okay, 1, 2, 3. Okay, so what I illustrated is you keep applying the same exact technique month in, month out. And actually, if you begin to add up the numbers for this example, you'll be able to pay your balance off completely within 6 months. Okay, so next month, after 6 months, since you are at 0, or in our example, we are at 0, you can't take that money again and apply it towards a card that has a 0 balance. So what do? Well, this is where we have to create more debt. And you see, not all debt is bad if you know what you're doing. There's actually good debt. So what you would do is you go to the bank and you tell them that you want to apply $12,000 from your line of credit towards paying down the principal of your home mortgage, your home loan. It's very important that the person at the bank that you're talking to understands that you're applying the money towards principal pay down and not a regular payment. Because if they process this as a regular payment, it's just going to take a bulk of it and apply it towards interest, and that's not going to work. So it's important that they understand that $12,000 is principal pay down. As soon as you do that, your line of credit balance bumps up to $12,000, and you keep applying the same strategy to pay it down. Where it is important to see how this is working is that you're able to pay down $12,000 in 6 months, whereas the regular way it had taken you 4 years from our previous example. So this is the strategy. So every 6 months, you keep going back to the bank and applying $12,000 because you're paying it down in 6 months, and you keep going through this process again and again until you pay down this balance. And that's how you pay it off within 5 to 7 years. Now, what about emergencies? Well, we have all this cushion over here for emergencies, emergency money. Okay, since we're no longer putting anything into savings. Again, since we're using an active account and not an inactive account to put our money towards, what is the bank going to do? Well, the bank is going to notice, so they're going to actually increase your limit because we're making monthly payments and we're paying off balances rather quickly. Another thing that's going to happen is your credit score is going to go up. Okay, so credit score is going to go up, and it's important for me to mention is that you never want to max out your credit card to the very limit, because that will actually have a negative impact on your credit score. So you always want to stay below the limit. So this is essentially the strategy. And now I want to just say, would you rather pay 21% or 6%? Thank you so much for watching this video. If you did find it helpful, please be sure to leave it a thumbs up, as I would really appreciate it. And if you know of somebody that might find this helpful, then please share it with them. Also, if you enjoy information about business and real estate investing, I will be putting out content around those topics every single week. So please subscribe to my channel to stay up to date with my videos. And if you still have any questions regarding this strategy, please leave them in the comments right below, and I will see you in the next video. Thank you.